Hello everyone, good morning. Hi, I am Paritosh Panchal. Welcome back. This is day three of our revision. Um, I would suggest you watch day one when we discussed certain exam tips. In day two, we discussed working capital and solved two questions from working capital. Today is day three, where we'll be discussing debt, cost of debt. Okay, and we'll be doing some questions relating to business finance and cost of capital, right? So let's begin for the day. Mhm. Before we begin, actually, I just want to ask you to please excuse me for my voice. I have a very bad cough and cold, so please pardon me. All right, so let's begin. Now, you would have noticed that in day one, we discussed that cost of capital and business finance is a very important topic, and a guaranteed, there's a high possibility that a question could be asked from this topic in section C. In fact, three topics were guaranteed. One is business finance and cost of capital, second one being working capital, and third one being investment appraisal. Right. So we won't be discussing the entire thing. We'll just be discussing the debt part of it. Okay. Just let me just check if the audio is right. If seems proper, I guess. So now within debt, we would also consider preference shares. We consider preference shares as a part of debt more than equity. Reason being, you do not get any sort of voting rights in preference share, and moreover, the main reason why we treat it like that is because you have to pay a fixed dividend, right? In case of debt, you had to pay a fixed interest. In case of preference shares, you have to pay a fixed dividend, right? And now there are two types of preference shares. It could be either cumulative or non-cumulative. Just a moment. Yeah. So there's cumulative and non-cumulative. And cumulative basically means that if in a particular year you do not earn profits and therefore you do not give off dividends. However, since they are cumulative, they will get accumulated and will get carried forward to the next year. So the next year, when you make profits, you have to pay last year's dividend plus this year's dividend. Okay. So the cost of preference shares is the returns expected by the preference shareholders. Preference shares usually have a constant dividend. So the same approach can be used as we saw with estimating cost of equity with no growth of dividends. So we had looked at in cost of equity, there were two methods. One was DVM and the other one was CAPM. So you will use the DVM without growth, similar concept or similar formula for preference shares as well, right? But just keep in mind before we proceed ahead, um, see throughout FM, the two terms are used very interchangeably. That is expected returns from the investor's point of view versus the cost of capital. See, understand this. If I am a preference shareholders, I am providing capital. That means I'm an investor. Okay. So I am expecting returns in form of dividends. The company, on the other hand, is paying that dividend. So from the company's point of view, it is a cost. It is cost of preference shares. From an investor's or my point of view, I would call it expected returns. So one person's return is the other person's cost. So cost is equal to returns, okay, and is used interchangeably. It's two different sides of the same coin, okay. So when we say cost of equity, it basically means expected returns by equity shareholder. When we say cost of preference shares, it means that expected returns by preference shareholders, right? So don't get confused as to certain places. The term cost is used in certain places. The term returns is used. Only in case of debt, it slightly changes. We'll come to it in some time, right? So very simple. It's your DVM formula wherein cost of preference shares, that is KP, is equal to D0, that is dividend today, divided by P0. Okay, which is X dividend market price, right? I let me just highlight this. It should always and always be X dividend. Okay, so keep that in mind, not cum dividend. Cum dividend means, what is the difference between cum and X? Cum dividend basically means that dividend is just announced. In anticipation of the dividend, the share prices go up. And once the dividends are paid, the prices come down. Let me give you an example. Say I am a holder of a share and the share is costing $100. I've been holding the share for quite some time, right? Um, I am wanting to sell this share and say, for example, I want to sell this share tomorrow. Okay, and today the company announced $1 dividend, right? So what will I as a seller say that, hey, I was to get this $1 dividend. However, I will get it after say 1 week. Maybe right now the dividends are just announced. The dividend will get paid after a week. Okay, after 7 days. So what will I do is I want the money today. I'm planning to sell the share today or tomorrow, whenever. Planning to sell the share basically after the uh, dividends have been declared or announced. Okay. So I'll say I'm willing to sell this share not at 100 now, but at 101. Okay. The buyer will ask that why 101? It was 100 yesterday. What changed? I can clearly say that, hey, listen, you basically are purchasing it for 100 only, technically, because you are paying me $101, but within a week, the company has declared a dividend of $1. That means they're going to pay that $1 to you. So it's like a cashback that you're going to get from the company. So you're paying me 101 and you're going to receive $1 from the company. So net outflow from your pocket remains to be 100, right? This is assuming everything else, there's no other news, everything else remains the same. Okay, the only change is the dividend announcement. So I'm going to demand that $101, and that price is called cum dividend. It is basically the old market price or the ex dividend market price plus dividend. That becomes my cum dividend market price. Okay, but keep in mind in the formula, the DVM formula, we only and only use ex dividend price, not dividend. So keep that in mind. Keep an eye out for any questions relating to cost of equity or cost of preference shares. And if you are to use a DVM, always ensure that the price is ex dividend market price and not cum dividend. If it is cum dividend, then just reduce. Now, what is your cue? If you find the words like dividends have just been announced, then the price they have given, though they have not mentioned it's cum dividend, it means it is cum dividend. And if words like dividends are paid or just paid, then it means it is ex dividend. Just a moment. Let me just adjust the light because it's coming on my face. Uh, yeah, I think this is better. Okay. Uh, so yeah. So KP stands for cost of preference shares. D stands for dividend or constant dividend that is paid because it's a fixed dividend. P0 is the ex dividend market price of the share. The fixed dividend is based on nominal value. Always remember, when you have like 5% preference shares, it means 5% is on what? Never ever on market value, always on the face value or the nominal. If nothing is given, we would assume that the face value is $1. But do not always assume it. Check the question. if an actual face value or nominal value is given or not. If not, we'll take $1, right? Now moving on to debt. There are two broad categories of debt. One category is tradable, the other one is non-tradable. So non-tradable is simple like bank loans. If you know that the interest you need to pay on the bank loan is 10%, then you will say 10% is my cost of debt. But keep in mind when it comes to debt, we will always take post-tax cost of debt. Why? Because interest is tax deductible. So we enjoy tax benefits on the interest payments. Therefore, we won't say that my cost is 10% because in front of this 10% cost, I am enjoying tax benefits. So I'll do 10% into 1 minus t. Say, for example, my tax is 30%. Okay, so 10% into 1 minus 30% is equal to 70%. So 70% of 10%, that is 7%. So my post-tax cost of debt will be 7%. So whenever you are thinking from a company's point of view, always remember we will only and only take post-tax cost of debt. And when we are thinking from an investor's point of view, we will only and only take pre-tax. Think of it logically. If I am a bank, I am earning interest. Okay. So this interest I earn, I'm not getting any tax benefit. So I'm going to say, what is my earnings? 10%. 10% is the interest. I earn 10%. When you talk from the point of view of the company that has taken that loan, they are paying 10% as interest. However, since they are paying 10% interest, they are receiving a benefit, an advantage, a tax benefit. How much of 30%? So they will say for them the cost is 7%, but the return for the bank remains to be 10%. The cash flow that the bank is getting is 10%. He's not getting any tax benefits. In fact, on this income, they would have to pay tax. Okay, so this is pre-tax income for them. So, from the point of view of a bank, 10% interest earned. From the point of view of a company, 7% interest paid. Right? So, bank loan is super simple because it's non tradable. There is no market value, there is only a face value. However, for traded type of debt, there are market values. Now, which means that it brings a concept called yield. Yield is calculated on market value, whereas coupon is calculated on your face value. All right. I'll give you an example of it shortly, but just keep in mind that in traded bonds, there are three major types. You have irredeemable, redeemable, and convertible. Irredeemable means you do not redeem the principal, you never pay back the principal. Redeemable means you pay back the principal, and convertible means upon redemption, investors are given a choice. Either they have a choice to convert it into equity or they have a choice of taking cash redemption. It's up to them. It's convertible in nature. So you can convert it to equity later on. Right? In irredeemable, as I said, no principal is paid. That means interests are just kept paying, being paid. Um, Now, estimating the cost of debt, the term loan notes, bonds, loan stock, and marketable debts are all interchangeably used. Gilts are debts issued by the government. So, gilt is nothing but government bonds. Then you have T-bills, which are short-term government instruments, again, debt instruments, treasury bills. Irredeemable debt is interest to be paid in perpetuity as there is no repayment of principal. Okay. You're not paying the principal, but you just keep paying the interest on and on and on forever. Redeemable debt is interest to be paid until the redemption of the payment, and convertible can be converted into equity later on maturity. Now the terminologies. As I said, coupon is the interest that the bond issuer has to pay. Now, this interest is calculated on face value. Say, for example, there's a bond of 10%, there's a bond face value 100, coupon is 10%, or interest is 10%. It basically means that you have to pay 10% of $100, that is $10 as interest. That's your coupon. Okay, so coupon rate is equal to coupon paid divided by nominal or face value, right? However, there is something known as yield also. Yield is coupon paid or the interest paid divided by market value. Okay, let me just give you an example. Hold on. Ignore this question for now. Say, for example, coupon. Another name for coupon is interest. So, interest or coupon is 10%. Face value is 100. Okay, market value is 100. Okay, so if you want to see coupon paid or interest paid, interest paid on $100 face, you are paying 10%. You're paying $10 for returns. Okay, yield, I would call it, or returns. Okay, what do I mean by yield? Returns. So I am getting this $10, but to get this inflow, what was my cost? Why am I getting this $10? Because I purchased the bond. For how much did I purchase the bond? For 105, not at 100. So my returns as an investor is 9.5%, not 10%. Okay, this is the cost to the company. However, actually, this isn't even the cost because cost will be post-tax. In fact, no. From a company's point of view, also, they are not going to get 100. They are receiving $105. So this is also known as pre-tax cost of debt. Okay, so it can all be known as yield or returns. Right, let me just. Okay, so let yeah. So the yield or the returns expected by the investor is 9.5%, which is also nothing but the pre-tax cost of debt. You understood the difference between yield and normal interest paid. Interest is 10%. That need not be your cost. Okay, your cost is how much did you receive? 105. So you have to pay 10%. That is $10, but not for $100, for $105. So it technically means you are paying 9.5% as interest. All right. So that is yield. Coming back to this. Nominal value, also known as face value or par value, is stated price within written on front of a security. Usually, it is also the redemption price. That is usually quoted at $100 nominal value book. See, if nothing is mentioned, always consider nominal value to be $100. That's why I made it bold. Many times in the question, it's just not given, and you start wondering what is the market value? Sorry, what is the face value? Face value is 100, or the nominal value is 100. Okay. Then you have market value. Market value is basically the price at which you can purchase the bond, the price at which the bond is being traded, and this price keeps changing on a regular basis, almost every few minutes, if not every minute. Then you have the yield. The yield is a bond yield is the return that the investors get for a bond over a period. So yield is equal to coupon received divided by the market value. So that's the only difference between coupon rate and yield. Both the numerator is same, that is coupon, but the denominator changes. In case of coupon rate, it will be face value. In case of yield, it will be market value. Now, same like how we have X dividend market price and cum dividend market price, we have X interest and cum interest. So if you know that dividends are to be received immediately, not immediately, but like within a few days, then you are going to hike up the price of the bond. And once these interests are eventually paid, the bond prices will come down, right? Now, let us discuss the costs. In case of equity, the company's cost of equity is equal to investors' required return. However, basically one person's cost is the other person's return. However, this is not true in case of debt due to the impact of tax relief or tax shield. Okay, so whenever we are thinking from the point of view of a company, we always take post-tax cost of debt. Reason, we enjoy tax shield. So KD is equal to required return of a debt holder, that is before tax cost of debt, and KD 1 minus T is cost of debt post taxes, is the cost of debt of a company which is post tax, okay, after paying any tax. So KD, that is the required return of debt holder, can also be referred to as yield or the return on debt, and is also known as the pre-tax cost of debt, whereas KD 1 minus T will be uh, post-tax cost of debt, which is what we use from the company's lens or company's point of view. So KD 1 minus T cannot always be calculated by simply taking KD and doing 1 minus T. No. Okay, you should reduce the interest and then calculate it. Should therefore consider it as post-tax cost of debt rather than a mathematical formula. Okay, it is not a mathematical formula that, oh, you have KD, you have tax, find out KD 1 minus T. That's the last thing you would do. Like if no other information, if interest related information is not available, only then you would do it probably. In fact, you wouldn't anytime. Okay. See, sometimes it comes correct, sometimes it doesn't come correctly, right? Um, so for example, consider two companies identical apart from the choice of finance. A is equally financed, whereas B has $10,000 of 9% fixed interest debt. So both have 10,000 interest. Okay, in case of B, they had to pay an interest because they are the firm with the loan. So 9% they have to pay. Profit before tax, we find out the taxes that they pay, and we find out the profit. So clearly it is seen A has $7,000 profit, whereas B has $6,370 profit, despite same interest and despite same PBIT. Okay, so they had identical sales and cost. The only difference was interest. B has basically paid $270 less tax before because the tax deductibility of the debt interest. So if you can see that though B is paying $900 extra, it ends up paying lesser tax. Therefore, your profit after tax has not come crashing down by 900,000, but lesser. And since these taxes are low, my tax that I pay is also low. Since profits reduce, tax paid on those profits will reduce, right? B has paid $270 less because of tax deductibility of the debt interest. Therefore, the net cost of debt interest to B is 900 minus 270, that is $630. So B's actual cost of debt is 630 divided by $10,000, which is 6.3%. Okay, how did you get 6.3%? And this is basically interest 1 minus t, where I is coupon or interest and t is rate. Okay, so this was just one example. Then you have irredeemable debt, wherein you just keep getting interest, no redemption. So over here, you will do like a perpetuity discounting because it's perpetual interest. Company does not repay the principal but pays interest forever. The market value is the future expected income stream. That is the interest from the debt discounted at investors' required return. So, see, market price of any instrument is the base principle is that it is nothing but the present value of all the future cash flows for it. So, if you have an irredeemable debt, all the future cash flows is just interest, right? So, the market value will be the present value of all the interest that it receives. Okay, now for NPV, we need to discount it. Okay, for present value, we need to discount it. So at what rate? That rate is the cost of debt, right? So market value is equal to interest divided by KD, that is cost of debt. And if you rearrange it, you can say cost of debt is equal to interest divided by market value. And KD1 minus T will be interest 1 minus T divided by market value. Do not take that KD and just do 1 minus T. No, in that approach you sometimes will get the correct answer, sometimes will not get the correct answer, so avoid it. It's better if you reduce interest, adjust interest as 1 minus t and then divide it by market value. Okay, this kd is nothing but the yield. Okay, yeah. Where I stands for your annual interest in dollars starting in 1 year's time, P stands for your corporate taxes expressed as decimal, and market value again is in dollar terms, okay, as of year zero. Um, Irredeemable debt is KD is equal to debt holders required return, that is pre-tax cost of debt, okay, from investors' point of view, expressed as a decimal, also known as an yield. And KD1 minus T is a post-tax cost of debt expressed in decimal or percentage. In case of redeemable debt, the company will pay interest for a number of years till maturity and then repay the principal, sometimes at a premium or discount at the original value. See, if it is redeemable, say it is a 5-year redeemable bond. So year 1, year 2, year 3, year 4, year 5, we'll keep getting interest, 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 interest. And finally, in year 5, you will get the principal repaid. Okay, redemption basically. So year 0, there is an outflow from your pocket, that is, you are purchasing the loan, purchasing the bond. And then there is inflow, 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 inflow in terms of interest. And at the very end, there is another last inflow in terms of the principal. Okay, so this repayment or redemption is sometimes done at a premium, sometimes at a discount, and sometimes at par. So you need to read in the question, how is the redemption being done? If nothing is mentioned, we assume at par. At par means par means face value. Okay. Always remember redemption at par is redemption at face value. The market value of redeemable loan notes is the sum of the present value of interest and the redemption payment. This is from a bond valuation point of view. Nothing, market value is nothing but the present value of all future cash flows. The future cash flows in this case happens to be interest and at the very end, redemption. So therefore, investors' required return is the IRR for the investment in the loans. Okay. So all you have to do, very simple, is if you have to find cost of debt 1 minus T, you have to just do IRR of all the cash flows. That's it. And in your exam, you are lucky that on the CBE platform, the IRR functionality is available. So you can just do is equal to IRR, bracket open, and select all the cash flows. Okay. Uh, So KD 1 minus T is equal to IRR. Remember, interest should be less of tax. Please note interest payments are tax deductible. The cost of debt can therefore be found by calculating IRR of the investment flows. Okay, so T0, you will write the market price, and then T1 to Tn, all the interest payments, but 1 minus T, and then finally capital is repaid. Okay, and you have to discount all of them. Or you could just, if you're finding the discounting rate, that is cost of debt, then you can just select all of them and find the IRR. Okay. Debt redeemable at current market price. Where debt is redeemable at its current market price, then the position of an investor is that of a holder of a redeemable bond. Okay, so if in the question you find that redemption is at market value, not at face value, then you can treat it like an irredeemable bond, where, for example, a redeemable loan note trading at 105 with a coupon of 7 due to be redeemed at 105 in 3 years' time. So you can directly just use interest divided by market value form instead of finding the IRR. Even if you find the IRR, you will get the same amount, same value. Then moving on to convertible, sort of the last types, convertible bond. Okay, wherein you get an option to convert to shares. Okay, so convertible debt, just a moment. Yeah, convertible debt starts off as a loan, that is, it starts off as a debt, but allows the investors to choose between taking redemption proceeds, that is cash, or converting the loan notes into a preset number of shares. So you have a right, basically, to become a shareholder through a convertible debt. You won't become a shareholder immediately, not right now, but after whatever the tenure of that bond is, say after 5 years or where. Sometimes it is also you can convert it before the due date also. Okay. Now to calculate the cost of convertible debt, you should first calculate the value of conversion option using available data. That means you basically have to ask yourself that, all right, I know that for the first 5 years, I'll receive interest. But on the fifth year, I have an option, I have a choice. I can either opt for getting cash redemption. Now, cash redemptions, like say it is par. So I know per bond I'll get $100. Okay. Or I can convert it into 6 shares. And if the share price is not 6 shares, let's make it 11 shares. Okay. If the share price is $10 a share, then I know that 11 into $10 is $110. So I have an option to either take $100 of cash or $110 or equivalent of shares. Okay, or shares worth $110. Obviously, I'll go for 110. Yeah, more value. If I wanted cash, I would take this $110 shares and sell it in the market and get my $110 instead of $100 which the company was offering. Okay, so step one will be, sorry. Step one will be to calculate the conversion option so that we can select which option to select. Then we compare the conversion options with cash option and assume all investors will choose the option with higher value. That makes obvious sense. And then calculate the IRR of the flow as redeemable debt. Okay, note that there is no tax effect on cash redemption or share conversion, whichever option is chosen on the conversion date. Okay, so remember on redemption, there is no tax effect, irrespective of whether you're taking cash or shares. Okay, and in case of your non-tradable cost of debt, we just take bank rate 1 minus T. That's it. Interest 1 minus T. That's about it. Okay, very, very simple. Right. Alternatively, the cost of any normally traded debt would be used instead. For example, when the examiner does not give you the interest rate. Market value of the non-tradable debt is equal to book value. Okay, so there is no such thing as market value for a non-tradable debt. It is not traded only. How will you get a market value of it? Okay, and then you have to calculate WACC. Now, WACC is the weighted average cost of capital. Okay, now you have to take all the different sources of capital, your cost of equity, your cost of debt, your cost of preference shares, all of that you find out. Okay, you weigh it, you will weigh it only and only as per market value, unless in the question it's explicitly given use book value or no information relating to market value is available for any of the instruments. Okay, in that case, you would use book value, but we prefer using market values. So, weightage as per market value into the cost per uh, that source of capital. Multiply the weights with the cost, and you get your answer. Okay, so right. Now let's just read. After one calculates the cost of equity, preference shares, and debt separately, it is possible to weigh it according to its importance in the financing mix and calculate the WACC, which is used as a discounting rate and project appraisal. So, yeah, this is, let me just highlight this. Okay, see, this is kind of linked with your NPV. How? Because whatever WACC you calculate is basically used as the discounting rate in NPV. Okay, or discounting rate to basically find anything's present value, right? We used to take, they used to call it discounting rate, they used to call it cost of capital. That cost of capital is nothing but weighted average cost of capital. They used to say expected returns. As I've explained earlier, one person's returns is the other person's cost. Only in case of debt, it's slightly different because of tax benefits. The choice of weights to find an average cost, the various source of finance must be weighed according to the amount each held by the company. The weights of the source of finance could be either your book value or the market value, and we would prefer using market value wherever possible. So if you have to calculate weights, you first have to find out how much total equity is there. So that is market value, share price per share into total number of shares. That will give you the total value of equity. And same thing for debt also. We'll take either we take the total nominal value divided by 100. So from the balance sheet, we'll find out that how much is the book value of the debt. So basically, we are finding out number of bonds. Okay, so that's total nominal value divided by 100. Why divided by 100? Because we assume, let me write this. Okay, this is nothing but the assumed face value, $100. Okay, into current market value. So basically, both the formula is same. That number of units issued into the market price. That's it. Okay, so to calculate first, we calculate the weights of each source of capital, then we calculate the cost of each source of capital, then we multiply the weights to the cost, And then now add all of them up and we get our WACC. So this is the formula, that value of equity divided by value of equity plus debt, which is basically nothing but total capital employed. So value of equity divided by total capital into cost of equity, value of debt divided by total capital into post-tax cost of debt, because we are looking from company's point of view. Okay. So VE stands for value of equity, VD stands for value of debt, KE and KD is cost of equity and debt. Now, when to use the WACC? The WACC calculation is based upon firm's current cost of equity and debt. It is therefore appropriate for use in investment appraisal, provided that the historical proportion of debt and equity is not changed. So, see, if there is any new project you are undertaking and the cost to equity, debt to equity level doesn't changes, you can use the old WACC. If the operating risk will not be changed, then you can use the old WACC. If the finance is not project specific, that is, it is coming out from the pool of funds, you can use the old WACC. If the project is small in relation to the company, so there is no significant change, then you can use the old WACC. If any of these criteria are not met, you will have to recalculate WACC. You cannot use historical WACC. You have to say, for example, your business is in a restaurant and suddenly you start frozen food. Different businesses, different risk. So WACC will change. See, WACC constitutes of cost of equity, cost of debt. Cost of equity is sensitive to risk. If the risk that the company takes is more, then the equity shareholders are going to demand more returns. If you remember CAPM, method of valuing equity, CAPM method of calculating cost of equity, we used to take something known as beta, which is a measure of systematic risk, correct? Okay, so it's a measure of systematic risk. That means due to the risk faced by investors, returns are determined. So if the risk changes, your WACC will change. If the capital structure, the weightage of the proportion of capital changes, that is your debt to equity level changes, your WACC changes. Okay. So with this, I think we are done with the theory part. We'll take a quick 5 minutes break and then we will start with the calculations part. So see you in 5. All right. I hope we are back. Uh, okay, great. So let's begin with the questions. And now, again, like last time, I have selected questions which students or areas which students would tend to ignore. Okay. Mhm. So first question is your okay, I won't say it. Let's just read the requirements first. So what are we required to do? Okay. We are asked to calculate the expected WACC uh, of fly high. So we know straight off the bat that it's a question on WACC. Part B is asking us explain the impact of a new bank loan on cost of equity, cost of debt, and WACC. So it's a theory question. So 3 plus 3, 6, 7, 8, 8 marks theory. And part C says explain why Fly High might decide to raise capital in form of convertible debt issued rather than straight equity or debt. That's another theory question. It's 4 marks. So 3 plus 3, 6 plus 4, 10, 12 marks is theory, and just 8 marks is calculation, right? So you understand the importance of theory and why I was saying on day one that theory is very, very, very crucial. Okay. 50% would be in this particular question, it's more than 50% which is coming as theory. All right. Mhm. And these are simple theory. Like if you look at what is the impact of new bank loan on cost of equity, cost of debt, and WACC, it's nothing but your capital structure theories, wherein if you take additional debt, what impact does it have on your cost of equity? Well, cost of equity will rise because financial risk has gone up, credit risk has gone up, default risk has gone up. All those risks have gone up basically. Therefore, the equity shareholders will demand more returns. So when debt increases, the cost of equity will also increase. What will happen to cost of debt? Well, cost of debt typically will remain where it is. See the proportion of debt. See in the WACC, if you look at the WACC, wait, let me just show you how WACC is calculated. Okay. So in WACC, we calculate weights, we calculate the cost, and then we find WACC. Now, if the proportion of debt increases, that is not going to change the cost of debt. Okay. Yes, but however, if the debt has gone some really high level, okay, then beyond that, if you take debt, okay, when your debt to equity level is super high, that's when the bankers or the debt investors are going to say, you are becoming more risky. We want a higher return. That means your cost will go up. So to a majority extent, cost of debt will remain same. But if the proportion of debt exceeds a certain level, only then cost of debt will go up. Whereas cost of equity will most likely go up because of increased debt. And WACC, now there are various theories around it. So they specifically mention the traditional model. The traditional model says that initially, to some extent, when cost of debt when proportion of debt increases, that is more debt is taken, the overall WACC will reduce. That is, the cheapness of debt will compensate or more than compensate the rise in cost of equity. But once the optimal WACC is achieved, okay, optimal WACC is the minimum WACC. So once that's achieved, then additional debt is going to increase your WACC. It's not going to reduce it. So to begin with, it reduces your WACC and then eventually the WACC will rise. So you need to explain that. It's a pretty simple thing. It's an easy 8 marks that you can earn, right? And then why would they want to get convertible debt rather than straight equity or straight debt, right? So because you are giving an option to the shareholder, to the investors to convert to equity, which means, say, for example, if the equity price currently are low, okay, so issuing new equity would, you won't be able to get a good valuation right now because the market prices are low. You cannot issue at a price at a premium to the market value. So you may want to hold off. Okay, so you may not want to issue straight equity right now. For now, you would give it out as debt and then eventually you convert to equity. Okay, anyways, we'll discuss all of these things later, but we know that uh, our focus is on finding WACC. Since we want to find WACC, we want to find cost of debt, cost of equity, cost of preference share, all the various costs we need to find. Cost of equity either on basis of DVM model or on basis of CAPM model, depending on the variable available to us. When it comes to cost of debt, we would try to identify the type of debt, redeemable, irredeemable, and accordingly find out the cost. But always remember post-tax. Okay, so Fly High operates a low-cost airline and is a listed company. In comparison to its major competitors, it is relatively small, but it has expanded significantly in the recent years. The shares are held mainly by large financial institutions. The following are contracts from Fly High's budgeted statement of financial position for, or rather, as on 31st May 20x2. Let me just call it 2022. Okay. Now, ordinary shares is $0.5. This is the face value, and this is the book value 50. So basically, if I want to calculate the number of share, okay, I just have to do 50 divided by, okay, I won't be able to cell reference it, but 50 divided by 0.5. Okay, so there are 100 ordinary shares issued, right? Just giving you an idea. Reserves and loan notes. Now, this is at nominal value. So you would say 200 divided by 100 is the 2 million loan notes. Okay. This is how you will calculate if you want the number of loan notes and number of equity. Now, let's see if we actually require that or not. Let us proceed. So these are basically book values. Okay. These are, okay, I won't write it, but just understand these are the book values, right? Dividends have grown in the past at 3% a year, resulting in an expected dividend of $1 per share to be declared and paid on 31st May 20x. Okay, so dividend paid on 20x2. So let's write that. Okay, our financial summary. So it $1? Yeah, $1. Okay, dividends grown in past year at 3% a year, right? Let me just bold this. Then dividends are expected to grow at 4% a year from 1st June 20x2. Expected dividend growth. Okay. For the foreseeable future. So it's forever. The price per share is currently $10.4 ex-dividend price. So they have explicitly given us ex-dividend. So that's what we need. Okay, how much is our ex-dividend share price? This is dollars. Right. And is not expected to change before 31st May 20x2. The existing loan notes are due to be redeemed at par on the 31st May 20x5. Due to be redeemed, okay, fine. So that means we know that the redemption date 31st May 20x5. Okay, the market value of these loan notes at 1st June is expected to be 100.84 and nominal value is 100. So MV 100.84, whereas face value is $100. Interest is payable annually in arrears on the 31st May and is allowable for tax purposes. The tax is payable on profits at a rate of 30%. Assume tax is payable at the end of the year in which the taxable profit arises. Okay, so then the same year, the year end, basically, you have to pay taxes also. A 30% tax. Okay, so we can write that down also. Okay, that's it. That's all the information we have. Oh no, we have some more. Company has decided to purchase three additional aircraft at a cost of $10 million each. The board has decided that the new aircraft will be financed in full by an 8% bank loan on the 1st of June 20x2. So on additional loan taken on 1st June 20x2. Well, it is, what is the price? 10 million each. So 10 million into 3. The coupon was 8%. Okay, it's $30 million. Yep. So this is taken on 1st of June. We asked to find the WACC as of 31st May, right? As on 31st May. So from the looks of it, we have data of dividend given, no data relating to risk-free rate of beta. So CAPM model is ruled out. We have to focus on our, what do you say, uh, DVM method. Okay. So DVM method, now there is with growth, without growth, but some growth rates have been given to us. So we will do the cost of equity is equal to dividend into 1 plus G divided by KE minus G. Okay, or we rearrange it for cost of equity. So cost of equity is equal to D0 1 plus G divided by P0 plus G. Okay, keep the brackets in mind. This is how you would write it. That plus growth will be taken at the end outside the bracket. Okay, so practice. That's the reason why I've asked you to practice on the CBE platform. It's going to help you get familiar using these brackets and calculating. So first, the easy one, D0, we have it over here. $1 dividend is paid. We have the price, $10.4. Okay, ex dividend share price. Now the growth can be a little tricky because we have two growths, this and this. But understand, we are finding the cost of equity as on 31st. So we're looking at future growth, right? Growth is in the future, not in the past. We are expecting that expected to grow from 1st June till perpetuity. This was okay. So we will look at 4%, not the past growth rate. Okay. So always remember, we are talking about future growth rate. Growth always happens in the future, not the past. Right. So our growth rate will be 4%. That was the tricky part. Some people would take 3% or would just get confused and go either ways. Right. So keep in mind future growth rate. Okay. So 4%. And therefore cost of equity is equal to 14%. Okay. Now we found cost of equity. We need to find cost of debt. So what is the coupon on debt that we have to pay? So first off, we understand it is a redeemable bond. Okay. Now there is no interest given. Let me just read. Existing loan notes are due to be redeemed. The market value of these loan notes are interest is payable annually in arrears. Oh yeah, here it's given 9% loan notes. So I'll just write that also down. I missed that. Okay, 9% interest. So you know that every year you have to pay 9% and you have to pay till 31st May 20x5. Currently it's 20x2. So this would be 20x2, year 0, and year 1, 2, and 3, because 31st May 20x5, so that's 3 years. We will keep paying $100 into 9% into 1 minus T. Remember, always post tax. So $100 is the face value, 9% is the interest, 1 minus T is tax shield. Okay, the tax benefit. So year 1, year 2, year 3, you keep getting interest, interest, interest. Okay, and then finally you redeem at par $100. Okay, but what is the market value? Market value today is 100.4. So that will be considered like an outflow. This is an inflow, inflow, inflow. This is kind of from the point of view of the uh, investor. But if you had to put it from the point of view of the company, this would be a positive cash flow. That is, it's an inflow, and then all these would be outflow, outflow, outflow. Okay. The reason I keep it in this way because in that you will get a negative cost of debt. Okay, so just to keep the cost of debt as a positive figure, this is how I like to present. Okay, the net cash flow is nothing but the summation of all the cash flows. So first cash flow is the market value, second cash flow is interest, and third cash flow is redemption. You add all of them up and you find the IRR. So all you have to do is equal to IRR, bracket open, select all cash flows including year zero, and you'll get 6%. Also remember for IRR, your first cash flow should be an outflow, ideally. Okay, so 6%. So I found my cost of equity, I've highlighted it. I found my cost of debt, I've highlighted it. Remember post tax, obviously. Okay. So now what else do I need? I need proportions. I need to know that how much equity, how much debt. Okay, now one way of taking proportion is straight off the bat, take book values. Book values have been given to us. So 50 plus 50 would be 100 and this would be 200. Okay, so we either take that or we take market values. So once we take market values, we'll say number of equity shares is equal to 100. Okay, how did we find out? I showed you earlier when I was reading the question. You take the book value divided by the face value per share, you will find the number of equity shares issued. That is 100 million shares issued. And price per share. So that we have found out, or rather, it's given. Where is it? Yeah, over here, ex dividend share price, or over here, $10.4. Okay, so totally there is these many $1 million worth of shares. So it's almost $1 trillion, sorry, $1 billion. Okay, then number of loan notes, same logic. You will take the book value divided by 100 and get it. Now keep in mind that when it comes to number of shares, okay, sorry, nothing. Okay, where was I? Yeah, number of loan notes. Okay, so 2 million. Now price per loan note will be 100.84, which is again given in the question. So we have noted it down over here. Just multiply the two and you will get the total loan note value, right? So your total capital employed is the summation of those two. Total equity plus total debt is equal to $1.2 billion. Okay, so now I'm just putting it in a table format. And then I know the value of equity, I know the value of debt, I know my total value. So therefore, I'm calculating my weights. Weights is nothing but this divided by this. That is value of equity divided by total capital employed. And I'm locking total capital employed by the dollar with the help of dollar signs. So $C, $70. Then I just have to drag and drop it. So I know that the formula will properly copy paste itself. So the weightage of equity is 84% and the weightage of debt is 16%. So the structure has less debt as of now. Okay, and cost we calculated above. We use cell referencing and put in our cost of equity, cost of debt. So equity costs 14%, whereas debt costs around 6%. That's 5.99%. Okay, and then we multiply cost with weights and do a summation. So to 12.7% is WACC. Okay, very simple. With that, we find our WACC. This is WACC as on 31st May 20x12. Okay. So that's how our WACC will be. Then moving on. So part A is answered. We earned our 8 marks. Very simple, very straightforward. The only tricky part was that uh, dividend part, okay, the dividend growth. And the other tricky part could possibly be that uh, interest is paid annually in arrears, okay, and is allowable for tax purposes. So, what is this annually in arrears? Nothing. It's just paid at the end of the year or the beginning of the year, or however you want to treat it. Basically, after that year is over, it's paid. Okay, say for example, 2023 gets over, and then it will be paid. So basically, they are saying that it will be paid on 31st May every year. So whatever you are getting payment is of the previous year. Okay. So yeah, that's the only thing. Tax is not paid in arrears, it's paid at the end of the year. Okay, so there is no 1 year delay in taxes. Yeah, so we calculated our WACC. Now let's move on to the next question. Explain the impact of new bank loan on fly highs, cost of equity, cost of debt, and WACC. So they are proposing an additional loan of $30 million at 8% coupon. So we can say that in this particular scenario, when additional debt will be taken, okay, cost of equity will obviously go up. Okay, it won't be 14% anymore. Why? Because financial risk increases. Equity, then you kind of like can give an example. For example, equity shareholders will find it risky that more interest needs to be paid before dividends are paid. Okay, so their risk increases, um, and therefore they are going to demand more. So that's the impact on cost of equity. Cost of equity will go up. When it comes to debt, well, our existing cost of debt is 5.99%, whereas this one we are funding it through 8% bank loan. Now, this, if we had to do a quick calculation, you could just do 8% into 1 minus t. What is our tax rate? 30%. So it's almost the same 5.6%. Wait, sorry, 5.99. And this, so basically, this debt is cheaper at 5.6. Okay, so we can just say that cost of debt would almost kind of remain the same. Overall cost of debt would kind of remain the same because it's a small loan, like yeah, against a $202 loan, which we already have. You are just adding 30 million to it. So it's a small amount, more or less is going to remain the same. Okay, and it would just slightly reduce because the new debt is cheaper than the existing cost of debt. So slight reduction. And from the overall fact point of view, from a traditional model or traditional theory, says that initially the WACC will drop, and after a certain point, WACC will increase. Um, it feels like in our particular case, the WACC will reduce. Also, one more point I missed out in debt. If the proportion is very high, okay, in such scenarios, even cost of debt will go up. But here, very clearly, they have given the cost of debt. So, but it's a good idea to mention. So remember proper heading. So you are writing cost of equity, then you are writing a paragraph on cost of equity. So the cost of equity will rise if the company takes out extra loan. Interest and debt repayment burden will increase the risk that Fly High will not be able to pay dividends, and also increases the risk that Fly High will run into financial difficulties through not being able to meet its loan commitments. If liquidation occurs, debt holders will rank before equity holders. Therefore, equity holders will demand an increased level of returns to compensate for this risk. Okay, so proper, all the different angles that not only are you increasing the risk of interest repayment and debt repayment, but also you could have some other financial difficulties. And in that case, if you're not able to pay off your loan, okay, and they file for liquidation, then the debt holders get priority because they are secured. Equity holders bears the most risk. They will not get anything in return. So to compensate them for all these risks, they will be given more returns, or they will at least demand more returns. Okay. Then you have your cost of debt. According to the traditional view, cost of debt will remain unchanged up to a certain level of gearing. Above the level, it will increase because the financial risk that the company will not be able to meet its commitments, and hence interest and even the principal may get jeopardized. Okay, so see, always because over here example is given. So when you make a point, you can, if because is not possible, use an example. Now WACC. According to the traditional view, the WACC will fall initially as debt capital is introduced because debt at first has a lower cost than equity, being a lower risk investment. Ultimately, however, the WACC will rise as the risk level increases, resulting in the rise of cost of equity becoming more significant, and ultimately the cost of debt will rise. You could also write something like initially the cost of debt will drop because the cheapness of debt will be able to overcompensate the rise in cost of equity, but after a certain WACC, okay, or after a certain gearing level, the increase debt or the cheapness from increase in debt will not be able to, no longer be able to compensate for the rise in cost of equity. Say the company has 90% debt, equity shareholders will get scared. They will demand more. So the benefit that you will enjoy in cheapness of debt is not able to compensate for the rise in the cost of equity. Therefore, net effect is increase in cost. Okay. So ultimately, however, the WACC will rise as as risk level increases, resulting in the rise in cost of equity becoming more significant, and ultimately the cost of debt will rise. The optimum level of gearing is where the company's WACC is minimized. Okay. Then they are talking about convertibles, explain why Fly High decides to raise uh, capital in form of convertible issue rather than straight equity or debt. So they are asking might decide to. So what are the advantages, or what are the things in support of convertibles? Well, companies normally issue convertible in expectation that the holder will exercise their options. Convertible are therefore be seen as a form of delayed equity, so they are attractive to the firm when the price of ordinary shares is abnormally low at the date of issue. So if the current market price is low, then you won't be able to issue fresh equity at higher valuation, right? You will have to provide it either at current market value or usually at a discount to the current market value. Only then it will invoke buying interest. Or if that's not the case, then if you just simply like you want to issue equity, but you're not able to. Why? Because if you issue equity right now, your EPS is going to drop, your earnings per share. It's earnings per share. If the number of shares goes up and earnings remain same, then EPS will automatically drop, right? So you don't want that. So you are saying that I want to issue equity, but just not immediately, a little later. So convertible bonds work that way. However, they also carry risk that the share price will not rise in line with expectation at time of issue and the holders will not therefore convert. So they are hoping that the bondholders will convert to equity, but there is a risk that if the share prices have not grown, then they are going to opt for cash. If loan notes are dated, the company must have funds in place to allow for redemption on the due date. Okay, if there is a fixed redemption date, then you need to ensure that if in case people opt for cash, then you should have cash. You should arrange for that cash. Convertibles also have a short-term benefits in that interest payments are allowable against tax. So that's another benefit because it's a hybrid instrument. It's partially debt, then could become equity. So initially you could enjoy tax benefits as long as you are paying interest. Strategic implications of convertibles therefore may form. So you see headings are given. Convertibles therefore may form a part of a strategy of a company whose objective is to raise new equity, but which, for the various reason, does not wish to go directly into the market in the short term at least. They're often preferable to straight loan notes since they do not commit the company indefinitely to the payment of large interest bills. So you know eventually it will get converted. So you don't have to keep paying interest on and on and on forever. Because typically what happens, one loan is paid off and then a new fresh loan is taken. Or rather, fresh loan is taken to pay off the old loan many times. They further allow the company to widen the investment base by attracting investors looking for a guaranteed short-term income plus the possibility of a capital gain at a later date. So it's, as I said, it's a hybrid instrument. So it has the characteristics of both uh, bonds, that is, you earn interest initially, and equity, that is later, not immediately at least, but later you could enjoy capital gains or you could incur capital gains and not interest. So what is capital gain? When you sell something, if you bought it for 100, you sold it for 120, then 20 is your capital gain. You initially deployed a capital of 100. When you sold it, you received 120. Okay. So capital gain, how much did my $100 gain? It gained $20 or 20%. Okay. Um, okay, I think we are done with this particular question. Just give me a minute. I'll just be back. Just give me a minute. Sorry, I was just coughing. Ah, boy. Now, let's move on to the next question. Question number two. LaForge. Let's lead the requirements first. We asked for the rights issue. Calculate the following: the theoretical X right price per share and the value of right per existing share. Another thing students ignore because it comes towards the end. They feel that X right price is not important. In fact, many feel it's not part of business finance, which is wrong. It is very much a part of business finance. Um, Assume that the investment goes ahead, calculate LaForge forecasted earnings per share for the coming year and the results per share, and the resulting share price if the if it finances the investment using either right issues or loan notes. And then discuss ways in which a company can issue new equity shares. New equity shares reduced for forthcoming in the past. Wait, sorry. Discuss the ways in which the company can issue new equity shares at a recent board meeting to discuss the financial financing option. One of the directors suggested reducing the forthcoming dividend. In past few years, Laforge has consistently paid a dividend of 0.08 per share. Its shareholders, including both financial institution and individuals. Okay. So there's some theory question we are asked to discuss that instead of raising new funds, what if we just stop paying dividends and retain that earnings? Would that work? They're asking us to discuss and recommend whether Laforge would raise the finance it requires by reducing its annual dividend. Okay. So 5 plus 6, 11 marks, and 3. So, and the balance is basically, so these are calculation. These seem to be theory. Okay. So let us now read through. Lafarge is a listed company which designs and manufactures air conditioning units, which are then sold through third-party retailers and distributors. Economic growth in the number of Asian countries has increased and demanded for its products, and Lafarge wishes to target these markets in order to generate sales and profit growth. To target these markets, Lafarge company needs new machinery, which will require an initial investment of 25.8. So we write that down, 25.8 new machinery requirement, 25.8, sorry, 25.48 million. Two options for raising the finance are being considered. So either you do a right issue at a discount of 30% to the current market price of 2.6, or a right issue at 2.6 dollars into 1 minus discount rate. Okay. So it'll be okay. I'm not calculating it over here, but all right. For now, we'll just say that the discount rate is 2.6. The current price is 2.6, and after discounting, the right issue will be done at 1.82. Okay. Um, uh, when we say after discounting, I mean after giving a discount to the current market price. So 30% discount it will be issued at. So it won't be issued at 2.6, but less. Second option is 6% loan notes with nominal value 100 and a redemption period of 10 years. So we can write that down also. Okay, I haven't written it, but we can write it now. Okay, I've written it over here, right? Then what else is given? Lafarge PE ratio is 11 times and is expected to remain unchanged whichever financing option is chosen. So it is 11 PE ratio. Uh, what else? Extracts from Lafarge recent financial statements. So we have profits from operations, we have profit after tax, that is PAT. We have the share capital with the nominal value per share, so we can find out the number of shares and find out market value also if need be. Without the new investment, the forecasted profit from operations for the coming year is expected to be same. Okay, so if you do not do the expansion, your profits will be the same. But if you do the expansion, then your profit will increase by 4.5 million. And 20% is paid as taxes. So first, they are asking us to find the theoretical X right price per share. Theoretical X right price, very simple. You take the market value of shares already in issue plus the net proceeds divided by total number of shares after rights. Okay. So we have to find all these things. So all this I have just written. Okay. So also, all this is basically your financial summary of sorts. Now, answering. So TERP, wait, let me just check. Yeah. TRP is market value of shares already in issue plus proceeds from new issues and new right shares. This is okay divided by number of shares in issue after the rights are issued. So current share price we already know is 2.6. It's given over here. Okay. Number of existing shares we can calculate it very simply. Okay, we have 35 is the face value. We have the nominal value sorry, this is the book value. We have the face value 0.5, just a division of it, 35 divided by 0.5. So we get number of shares. So we find the market cap of existing shares. So we found the market value of shares already in issue. Now proceeds from the right issue. So right issue is priced at 1.42 and number of rights that we are going to issue will be, well, uh, New machinery cost 25.48 per share. It's 1.82. That means we are going to issue 14 million shares. 14 million into 1.482 is nothing but the price of that machinery, 25.48, or the investment required for expansion, right? So we have value, market value, or proceeds of right shares issue. So we have the total market cap, that is existing shares and the right issues, and the total number of shares issued, that is 70 existing and 14 new. So theoretical X right price would be the division of these two. See, you can do it directly. You need not necessarily write so many questions, so many steps. I'm explaining it to you, so I have given you as detailed explanation as possible. If you see the exam kit, you will find a much simpler, shorter answer to it. Okay. Then they have asked us, so TERP we found out, 3 marks on. Now the value of a right per existing share. This is TERP. If you want to find the value of a right, is nothing but you will take TERP minus the issue price. So $2.47 minus the issue price. So 2.47 minus 1.82 is equal to 0.65. But this is value of the total right. In order to exercise your right, you should have some existing number of shares. So there is some, what do you say? There is a ratio that if you have all 182 million shares, then you can apply for 14 million. That basically means a ratio of 0. Sorry, if you have all 70 million shares, you have the right to apply for 14 million shares, which is basically a right issue ratio of 0.2. 0.2 of your existing number of shares you can apply. Okay, so you just have to then multiply the two and you will get the right per existing share. Normally we divide, but the ratio is expressed in a manner wherein in this case you will have to multiply. Okay, so that is value of a right per existing share. So now moving on, they say if you go ahead with right, what is the impact? If you go ahead with loan, what is the impact? And they said that our profits will increase by 4.5. Okay, so we will start off. It's a profit from operation. Initially, currently it's 25.5, already given in the question. This figure is from here. Okay, and over here we are going to add that additional income that we are going to get, 4.5. So as long as you are expanding irrespective of the source of capital, you will get this. Okay, less interest paid. Now for rights, interest paid will not change. But for loan, since you are taking additional loan, at what rate? Where is it? I must have written it in my summary. Yeah, 6%. Okay. So 6% on that new loan amount. Sorry. Yeah. D68 plus D53. D68 must be down here. Yeah. So face value of loan notes 100, coupon is 6%. So interest that we are going to pay is $6 a share, a loan note. Okay. Due to absence of information, we assume that the loan notes are issued also at face value, and the number of loan notes issued is 0.25 million. So interest paid will be $6, which is paid per loan note into 0.25 million loan notes. Okay, so 1.53 million, which gets, it's that additional interest that we will have to pay because we have raised via debt. Okay, so our profit before taxes are these now. Now we need to find out, see what else is given to us. Directly profit after tax is given to us. So we fill in what profit after tax is. 16.56, which is nothing but derived from here. Okay, we have profit from operations, we have profit after taxes. Profit from operations we wrote, interest we wrote, and we don't have profit before taxes. Or that would be kind of simple, just 25 minus 4, you'll get 20. Okay, but we don't know if there are any other expenses or anything. So to be on the safe side, how we have done is we for sure know that profit after tax is 16.56, and we for sure know that taxes is 20%. So this basically represents 80%, this is 20%, this is 100%, and you can just cross multiply and find your answer, or you can just add these two and understand that your profit before tax is this much. And then you kind of tally it, that, oh, does it match? So if I do 25.5 minus 4.8, so 20.7. So yes, it matches. There is no other expense that I am missing out on, right? So taking this logic, I continue. Now in case of rights, see, nothing different. So from here, 20% of this, okay, I'll get my profit after tax. Similarly for loan, 20% of that, of this, okay, I'll get my profit after tax. Okay, but just remember, in case of loan, my interest changes. I'll just put the change that's happening. One is this and one is this. These are the values which have increased. Okay, rest everything remains the same. Number of shares in circulation, previously it was 70 million. Okay, it's not a dollar, it's a number, right? 70 in case of right issue, we are issuing shares, so the number of shares will increase. In case of loan, no such thing happens, right? So just keep this in mind. Okay. So number of shares in circulation for loan notes remain the same. Divide PAT divided by EPS. We assume no dividend is given. Okay. So, or we'll just continue with this. So you get your EPS. You find out that if you do give out loan, then your earnings per share is increasing. Okay, PE multiple remains same, though practically PE multiples would change, but we are assuming it's given in the question, thus we are assuming PE multiples remain same. And then we just multiply PE into EPS and you will get your expected share price. Okay, so here a little bit of business valuation is also asked. Okay, so this is how you will find the expected share price. This was your working note. Again, clearly labeled. What is the working note about? Okay, and then moving on. So part one and part two is done. Now B, they are saying that, we did B also, right issue and loan notes. Now C and D, C says discuss in which ways in which a company can issue new equity shares at a recent board meeting. In which ways? Okay, so you can do like a right issue, you can, which we are doing. You can do like private placement, wherein privately you are giving it or offering those shares to certain individuals or certain institutions. Okay, private placement, you can do like an IPO if it's not already IPO, but in this particular case, it seems like IPO is done, um, because it's written over here that it's listed. Okay, so IPO is an option, and if IPO is already done, you can do something like a follow-up public offer. Okay, you can do QIP, different ways in which you can issue equity, right? Uh, so you can talk about those things over there, and then you can talk about that dividend part that I was saying, that if you do not pay dividend, then uh, would that suffice? So let's find out. Would it suffice? So we are doing B first. So dividend per share is 0.8. Currently, there are 70 million shares. This is So we are saying instead of raising capital through rights or loan, why not just not pay dividends and arrange for it? So if dividend per share is 0.08 and 70 million shares are in circulation in issue right now, that means we pay $6 million as dividend. How much do we require? We require $25 million. So how much is it as a percentage? It's a very small percentage, it's 22% arranged. So there is no point, uh, you know, trying to reduce dividend and upset people and raise capital rather than just simply raise capital. The director's suggestion of reducing the forthcoming dividend would raise at most $5.6 million. So, in itself, it would not be sufficient. You will have to take some other source of funding. This would reduce the amount of new external finance needing to be raised, potentially even reducing financing costs. There are problems with reducing dividends all of a sudden. You can talk about the signaling effect that it may give out a bad signal. Now, I'm not going to read through it. I am assuming you know all this. If you don't know, you can just pause the video over here and read the paragraph. So, signaling effect, which basically says like suddenly you stop paying dividends, sends a bad signal to the investor that what happened? Is there some problem with the company? Why did it stop paying dividends? It's our money. We want dividends. They stop. Okay. Then there is a, and there are both categories of investors, public as well as shareholders. So we don't know which person would take what as a signal. There's something known as clientele effect. That means there are different types of clients. So people earning more would prefer capital returns, capital gains, because capital gain tax is less than their income tax, whereas people in a lower income tax bracket would prefer dividend because dividend is taxed as per your income bracket and not as per capital gains. Okay. So in case if you are in a 10% income bracket, capital gain tax is 15%, so you will prefer dividend. If you are in a 30% bracket, you would prefer a capital gain and pay only 15%. So that's your clientele effect. Okay, so you can pause, read that. Then liquidity preference. Obviously, money today is more preferred. We prefer liquidity. That is, we want dividend today, then something in the future, share price may or may not grow. Who's seen the future? What if your project fails? Okay, so liquidity preference. So you can pause, read that paragraph. Moving on. Final recommendation. Given that Lafarge is a listed company with different shareholders and has consistently paid dividends in the past, a reduction in dividend could damage the shareholders' relation and possibly result in reduced shareholders' wealth. Okay, if you are not making your shareholders happy, those shareholders will sell your share and buy something else. When they sell your share, they are going to create a supply which may bring your share price down. A reduction in dividend is not recommended, therefore. Small change any which ways. Then methods of raising new equity. So right issue, you can pause and read. Private placement, pause and read. Public offer, pause and read. IPO, pause and read. We already discussed all of this. I don't know whether you read the liquidity preference and recommendation, so you can pause and read over here as well. So with this, we are done for the day. I'll see you tomorrow. My name is Paritosh Panchal. I hope I could add some value today. I hope you found these questions unique and worthy. Please practice these questions on your own once. I haven't really solved it over here, as in I've just explained it. I haven't literally solved it. So I want you to solve it. If there is any doubts that you're facing, feel free to ask. I will, if you want this document, you can ask, comment below, and the team will send it across to you. So, all the very best for the exam. Thank you so much for your time. I will see you tomorrow again, same time, on YouTube Live, and we'll be discussing the last topic, that is investment appraisal. Okay, see you tomorrow. God bless you.